Hi everyone, Brian here, and I have a simple question. Do you think you're going to become a millionaire? In the US, there are over 13 million households that have a net worth over $1 million, not including their house. That winds up being just over 8% of the US population that are millionaires. If you invest early with a diversified portfolio with items like ETFs, which are exchange-traded funds, then you should be a millionaire within 20 years of investing. I was able to do it in less than 15 years and retire in my 40s, and I think that a lot of you can do even better than that. For today's video, I will go over 9.1 high growth ETFs that can help you become a millionaire. I say 0.1 because I'm throwing in a high risk bonus ETF, which you can research on your own, but it is something to have on your radar. From there, I'll briefly cover what ETFs are and how they differ from mutual funds. Next, I'll cover the pros and cons. Then I'll review items to consider when choosing an ETF, and then I'll jump straight into the 9 high growth ETFs. About midway through, I'll also share with you a free comparison tool that I had created where I'd reviewed 34 different ETFs where I had narrowed it down to these 9. Let's get started by providing an overview of an ETF. In basic terms, an exchange-traded fund is made up of dozens or even hundreds of companies where the fund itself is traded on the exchange just like any other stock. Whereas mutual funds are specific to the exchange offering the fund, like the Vanguard Total Stock Market Index Fund that you can only purchase on the Vanguard site. Even though this Vanguard mutual fund is listed at $102 a share, it has a minimum investment of $3,000. Since an ETF is traded like any other stock, there is no minimum investment. And if you use a site like Webull or Robinhood, you can buy fractional shares, meaning if you only want $100 worth of an ETF via Robinhood, no issue. On the flip side, if you want $100 of the Vanguard mutual fund, well, you can just pound sand because it isn't going to happen with Vanguard. They don't offer fractional shares. Think of a mutual fund as more like an exclusive resort where only certain guests are allowed. Whereas the ETF is more like a Disney park where everyone is allowed and you'll probably have a lot more fun. Another area where ETFs are different from mutual funds is the tax efficiency. Mutual funds rebalance and redistribute the entire portfolio, which causes instances of capital gains taxes that are baked into the mutual fund performance. ETFs are considered more tax efficient because they have fewer trades because they tend to be indexed to the market, which results in fewer instances of capital gains taxes imposed on the fund. For example, the average emerging markets equity mutual fund paid out 6.46% of their assets, resulting in capital gains hitting the return, where the average emerging market ETF only paid 0.01%. Yes, that all goes towards your total return. If this is news to you, then you're probably like me when I first learned about the tax efficiency. And I literally looked at my mutual funds and said, what the 𝐓𝐴 is not a sponsor of this video. But you are each and every time you hit that like button. I appreciate your support, and you should also consider subscribing. Now getting back to the tax efficiency. When a group cashes in their mutual funds, the fund must sell off assets to pay for the cash out, and that causes more capital gains to be passed on to the fund. But for an ETF, if a person sells their share, there is merely another person making a share purchase on the exchange, which keeps the fund whole and not forcing assets to be sold for the cash out. And that is why an ETF is so tax efficient. The third area where ETFs differ from mutual funds is transparency. Mutual funds are required by law to disclose their holding once a quarter. Even then, they are allowed up to a 30-day lag in the reporting. An investor rarely knows what their mutual fund has in its holdings at any given moment. However, ETFs tend to share their holdings on a daily cadence. Now that I've given an overview of the ETF, let's discuss the pros and cons. When it comes to the pros, 1. ETFs are traded like stock every day on the exchange. It's open to everyone. Next, there's no minimum investment like you see with most mutual funds. And you can buy it in fractional shares if you use an exchange like Webull or Robinhood. Next, they are tax efficient, which means a better ROI for the rest of us. They also tend to have lower expense ratios. And ETFs are also diverse. Since they tend to mimic an index, they are made up of dozens or even hundreds of assets which minimize risk. And lastly, ETFs are transparent. You know what you're buying and holding on a daily basis. Now, as for the cons, ETFs lack focus. Since they're indexed to a market or a segment, you don't have personal input on the specific investments. Next, they tend to have lower dividends compared to individual stock. And lastly, they come with higher risk than a mutual fund that's been around for 30 years. That's my list of pros and cons. Now I'll go over 4 key areas to look at when investing in an ETF. The first area to look at is performance, which shouldn't surprise any of you. You review the fund, how it's performed over the past month, 3-year, 5-year, and possibly the past 10 years. My comfort level improves dramatically when I see all 4 of those time frames being positive. And as a minimum, you'll also want to verify the expense ratio and the dividend payout. Most every exchange offers great tools in researching funds, and they usually give a report card indicating the performance. From there, I like to look at the strategy of the fund. What is the point of the investment? What index are they trying to replicate, or what sector are they focused on? For example, there is an ETF called Equity Russia that is meant to mimic the Russian economy. For obvious reasons, that one sucks. Yeah, you can literally kiss that investment goodbye. Goodbye. There's another ETF with the sole strategy of being indexed to spirits and alcohol. Yeah, it did so badly that it was completely liquidated. And the third area to research is the sectors that the fund is made up of. This is a section that's a little bit harder to focus on, but it's an area where you want to make certain that your funds you're investing in aren't mirrors of one another. There's no point of buying two ETFs that have the same sectors and strategies. Also, there may be some funds that are heavily weighted in a sector that you may want to stay clear of. For example, the fund of Amplify Online Retail ETF, which has over 67% of the fund in the consumer discretionary sector. This is an area that tends to do poorly in a potential recession. Just throwing it out there. And the last area that I look at is the specific assets within an ETF. As I mentioned earlier, two funds may look the same with regards to the sectors they are in, but when you peel back a layer and look at the specific assets, you may see that the specific stock are completely different. It sounds simple, but reviewing the multiple funds' performance, strategy, sector focus, and specific assets isn't simple. There's not many resources that can provide those details across several funds all at once. And that's why I created the free tool that allows you to do that with the 34 funds that I reviewed. But I'll get to that later. Let's go ahead and get started with the top 9 growth ETFs. To help provide diversity, I'm going to provide 3 small cap ETFs, then 3 mid cap, and then finishing it off with 3 large cap, along with 1 bonus ETF that is extremely high risk. The first high growth ETF to review is SPDR S&P 600 Small Cap Growth ETF. The purpose of the fund is to mimic the S&P 500 Small Cap Growth Index, where at least 80% of the assets are in securities in that index. Inherently, small cap stocks and funds carry more risk since they are smaller businesses with more potential for growth and for failure. This fund is comprised of 339 funds, where the top 10 only make up 11% of the fund, ranging from UFP Industries to SPS Commerce. The sectors are fairly balanced between IT, financials, industrials, and healthcare. But overall, with it being small cap, the companies in the fund are not common names you hear every day. Over the past 10 years, this fund has had an average return of 12.8% with an expense ratio of 0.15%. That equates to about $15 a year per $10,000. And a dividend of 0.69%. Hey, at least the dividend offsets the expense ratio. Putting this into context, if you would have invested $10,000 10 years ago with an annual contribution of $5,000, it would be worth over $130,000 today. Granted, past performance is no guarantee of future returns, so I'm merely sharing this for illustration. Now moving on to the next ETF of Vanguard S&P Small Cap 600 Growth Index Fund, which is similar to the previous SPDR Small Cap Fund, but they are different with regards to the individual assets. This fund's top 10 assets make up 11%, ranging in companies like Omnicell to SM Energy Company. Over the past 10 years, this fund has had an average return of 12.7% with an expense ratio of 0.16% and a dividend of 0.69%. In this case, a 10-year investment of $10,000 with an annual contribution of $5,000 would result in over $130,000 today. That's pretty good given that this past year was horrible. Now moving on to our last small cap ETF, which is Vanguard Small Cap Index Fund, which tracks the performance of the CRSP US Small Cap Index of small US companies. The fund's top 10 assets make up only 3.3% of the portfolio, with companies like Quanta Services and Targa Resources. Over the past 10 years, this fund has had an average return of 11.7% with an expense ratio of 0.05% and a dividend of 1.45%. In this case, a 10-year investment of the $10,000 with an annual $5,000 contribution would result in over $120,000 today. The return isn't as high as the other two, but it does offer a unique set of diversification along with a very healthy dividend. Before moving on to the mid-cap ETFs, I want to cover the free tool that I created that you can use to do your own comparison of 34 high-growth ETFs. The first thing that I have to state is I am not sponsored or paid to do this. It was a tool that I created so I can quickly compare ETFs for my own investments. I did all the work, so you might as well use it too. In looking at the spreadsheet, there's 3 tabs, and I'll start with the ETF overview, which gives a brief description of the fund, the size, and the performance over several time periods, the expense ratios, dividends, and also what the return could be over the next 10 or 20 years within the assumptions listed. Next, I'd move on to the sector review tab, where I currently have the 9 ETFs that I'm showcasing on the video, but you can use the filter to select any of the ETFs. From this snapshot, you can quickly tell the differences in the fund's sectors. And in peeling the onion further, you can move on to the top 10 assets tab where you can see each fund's top 10 assets. Once you download the spreadsheet, you'll have access to all the data. So if you want to make your own pivot tables to dig in further, you're more than welcome to. The spreadsheet is available in the link in the description below, so feel free to use it to compare the 34 ETFs that I have on file. Next, we'll move on to the mid-cap ETFs with iShares Trust Russell 1000, which tracks the Russell 1000 Growth Index, which is made up of both large and small cap companies. The fund's top 10 assets make up 46% of the fund with companies like Apple and MasterCard. You'll notice that once you hit the mid and large cap funds, they almost all have Apple as their number one asset. In addition, the top 10 assets for mid and large caps make up usually around 50% of the total portfolio, unlike the small cap ETFs where it's around 10%. Over the past 10 years, this fund has had an average return of 15.8% with an expense ratio of 0.18% and a dividend of 0.5%. In this case, a 10-year investment of $10,000 with an annual $5,000 contribution, that would result in over $160,000 today. Yes, the expense ratio is higher than the previous ETFs and the dividend is much less, but the overall return is much better. Now on to the next mid-cap ETF, which is Invesco Solar ETF, and is set to track the MAC Global Solar Energy Index. This fund is heavily weighted in IT, industrials, and utilities, and the top assets range from Enphase Energy to Sunrun Inc. Over the past 10 years, this fund has had an average return of 21.1% with an expense ratio of 0.69% and a dividend of 0.09%. I honestly don't even understand why they give a dividend at that rate. For this fund, a 10-year investment with a contribution would result in over $220,000 today. If you haven't been investing in ETFs, you need to rethink your investments. And for my last mid-cap ETF, it is First Trust NASDAQ Clean Edge Green Energy ETF, which is tied to the NASDAQ Clean Edge Green Energy Index. The sector focus is on IT, consumer, discretionary, and industrials. And over the past 10 years, this fund has had an average return of a whopping 22.7% with an expense ratio of 0.58% and a dividend of 0.1%. For this fund, a similar 10-year investment and contribution would result in over $250,000 today. Now that has to get your attention. Next, we'll move on to the large cap ETFs with iShares US Technology ETF, which tracks the Russell 1000 Technology Index and is considered to be non-diversified because of the technology focus. The fund's top 10 assets make up 63% of the fund with companies like Apple and Salesforce. Over the past 10 years, this fund has had an average return of 18.5% with an expense ratio of 0.41% and a dividend of 0.29%. In this case, a 10-year investment of $10,000 with an annual $5,000 contribution would result in over $190,000 today. Now on to the next large cap ETF, which is Fidelity NASDAQ Composite Index ETF. And as the name suggests, it is tied to the NASDAQ Composite. Over the past 10 years, this fund has had an average return of 16.8% with an expense ratio of 0.21% and a dividend of an incredible 2.06%. In this case, a 10-year investment with contribution would result in over $170,000 today. For my last large cap ETF, it is, before I give my last large cap, make sure to wait for the bonus ETF that I'm going to provide right after that. And the last large cap is Invesco's 𝐞𝐞 Trust ETF, which is tied to the NASDAQ 100 index that is heavy into IT, consumer discretionary, and communication services. The top assets range from Microsoft on down to Costco. And over the past 10 years, this fund has had an average return of 18.3% with an expense ratio of 0.2% and a dividend of 0.45%. In this case, a 10-year and annual contribution would have resulted in over $190,000 today. Now I have one last bonus ETF to share, but it is not for the faint of heart. It is extremely risky. So risky that even in the prospectus it states that it is not meant for long-term investing and comes with severe risk. And that ETF is a large cap of ProShares Ultra Pro 𝐞𝐞𝐞, whose sole purpose is to correspond to 3 times the daily performance of the NASDAQ 100 index. Yes, you heard me right, 3 times. It is heavily weighted in IT, consumer discretionary, and communications. But wait till you hear the performance. Over the past 10 years, this fund has had a crazy return of 41.2% with an expense ratio of an equally high rate of 0.95% and no dividend. But with that type of return, who needs a dividend? In this case, a 10-year investment of $10,000 with an annual $5,000 contribution, it would have resulted in over $790,000 today. That's right, if you had invested $60,000 over the past 10 years in this fund, you would almost have $1 million today. But like I said, this ETF is risky with a lot of volatility. It may be down negative 50% one year and over 100% another year. Well, there you have it, my friends. That's my list of top high growth ETFs by market cap, along with a free comparison tool and a bonus ETF. As always, be safe with your money, and I hope you're able to get some value out of this video.